Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, whether you're active, passive, you've been working in the industry for decades, well, this is the YouTube show podcast where we're breaking down all the latest research, industry reports, data, original articles, all around the multifamily industry, housing market, and the macro economy. We have an incredible special episode for you today. Igor Popov from Apartment List is joining us, and we feature Apartment List all the time on the Gray Report. If you're a regular watcher, listener, subscriber, you're very familiar with the research that they put out. And so this is great to kind of get into the details, getting into the methodology and what's going on in the multifamily market, housing, and the general economy. Igor's got a great background covering all of those areas. So before wasting more time, let's just get into it. All right, everyone, welcome back to the Gray Report. Igor Popov from Apartment List is joining us today. Igor, how are you doing? Thank you for coming on the Gray Report.
Hey, thank you so much for having me. I'm doing well. It's Friday. We're making it through the week. I'm excited to talk all things rents and housing with you.
Absolutely. Like I was just saying just before we started, we feature the Apartment List reports, I think just about on a weekly basis, because you guys are putting out high frequency, but also really high quality data. At the Gray Report, we track different sources of multifamily market information. And, we really pay attention to what you all are putting out, because as you guys mentioned in your methodology, not all data is the same. The methodology can be incredibly different. And we see that all the time. So it's a real pleasure to have you on here. Just before we get started, I'm going to read a bio that I'd love to learn just a little bit more on your background, learn about Apartment List. But Igor is the chief economist at Apartment List, where he leads the research team in publishing original housing market research. He teaches an undergraduate seminar titled Housing, Neighborhoods, and Homelessness at Stanford University, and his research has been published in the American Economic Review. Prior to joining Apartment List, Igor worked as an economist and data scientist at Airbnb and earned his PhD in economics at Stanford University. Igor, that's a really impressive background and the perfect person to be on the Gray Report. Again, this is awesome. Love to learn more, just a little bit about your background, how you got into housing.
Yeah, absolutely. My background, as you can tell, is squarely in the economics realm. So, thinking back, kind of piecing it together, looking backwards, I think when I was a graduate student, I had kind of a disparate range of interests. It was a time in life where, we're working hard in the basement of the library, trying to understand econometrics and prove various theorems. But there were kind of multiple areas that interest me the most that seemed really disparate at the time. I was really interested in public economics and the world of housing, and I had part of my dissertation on homelessness funding. I was really interested in the world of kind of what was happening with where people were choosing to, or in some cases unable to find a place to live. And then I was also really interested in this new world of tech and online data sets that generated this wealth of information that just was unlike anything economists had ever been able to play around with before. And, when in academia, right, these are different fields with different professors, different advisors, different conferences and such. But then I've been very fortunate just kind of getting to find the intersection of those two kind of in my career at the private sector so far. So first kind of stint after getting my PhD at Airbnb, which was very much a mix of housing policy research alongside big data sets that we could play around with and do
I bet
things with. And then in the last almost 5 years now, taking that to Apartment List, which is also kind of getting to play at this intersection of how to build great products and learn from the wild amount of data that our online behavior creates, but also have that be meaningful for real world outcomes like where people live. I love that intersection, and so that's kind of what brought me here and what I'm. But you mentioned the sort of real time nature of it. I think that that's been a big shift during the pandemic. It used to be not uncommon for us to do research on the housing market with old census data and say, this
Yeah,
is what's happening in the housing
that's
market
fine.
right now.
Yeah.
It sounds wild now, but in 2019, we did research with the 2017 census data, and it was current. It was a good representation of the world. And I think it's been really a really monumental shift in the attention that we place on real-time data, just because the world has started changing so much more rapidly, especially in the housing market. And so we've been having a blast trying to keep up and trying to push the conversation forward.
Well, and it's different than other, other areas of the economy and other markets as well, because, unlike dealing with markets that have much higher frequency information, publicly available information, publicly traded companies in the stock market, housing is much more opaque. And you have to go to a lot of different sources to kind of really track down, and the methodologies can be different. And then you say, it's typically a slow moving industry where it doesn't change that much over month, week over week. How was that process in trying to find the higher frequency information? Because I assume, there's all of a sudden owners and investors are needing this information all of a sudden, where before it was, feel which direction the wind is blowing and use my intuition and gut. And I'm going to read some of these reports, but don't need to pay that much attention to them. But now everyone is looking for answers because they don't know.
Absolutely.
How are we able to kind of get up to speed and find some of those better sources?
I think one of the things that maybe makes our approach and our research team and the kind of products we put out a little bit different from most. There are a lot of great research shops in our industry, fortunately. And one of the things that I think that was a little different about the approach that we took was that we came from it really from a little more of a renter first approach. We're kind of at our core a consumer facing product. A lot of the other data providers out there really think with a more of a SaaS lens. And so we're really thinking about kind of what do renters need to see on our product? What as a renter would give me confidence to understand that I'm getting an okay deal or I'm getting screwed or somewhere in between. And how do you display that in a way that's compelling, easy to understand, easy to digest, but then has all the rigorous backing that you want from something that you can take and say, hey, here's what's happening in the housing market. This is an accurate representation of a broader trend and not just something localized or idiosyncratic. And so that really got us on the path to displaying and investing in kind of some of this real-time data that you mentioned before. I think before the industry started changing quickly and before the actual metrics started changing quickly, it was important to us to be able to tell the renters, open up our app or come onto our site, hey, here's what's changed since the last time you were looking for an apartment. And I think, again, when I joined in 2018 it was a little less interesting to the broader media and to the industry, just because did Indianapolis grow 4% or 3% this year? Well, maybe your life wouldn't change dramatically either way. And then once rents, vacancies, migration started to really create this whiplash effect in the market, really it was really, I think the first moment where I remember it was that with this incredible anticipation in that early kind of lockdown Tiger King era of the pandemic.
The Tiger King era, exactly.
When
exactly what you're talking about.
Yeah, it was a moment in time, and I think the whole industry was waiting for April 1st to see, are people going to pay rent on April 1st? And it was such a moment of intense focus on such a short time window that it really changed how we approach data. But fortunately, we had a bit of a head start in investing in and visualizing some of these data products because renters they care about what's happening now because they're in the market for a short window
right now. What's happening in the market right now.
Exactly.
And I think you all were one of the first groups that really started putting out really monthly information rather than quarterly or half of the year information, which was kind of the typical frequency from a lot of the research shops. And sometimes I think even maybe in higher frequency than a month. Certainly I know we were getting monthly updates for a handful of markets. And I guess backing up a little bit, you get into a little bit more apartment list. Tell us more about apartment list. What
absolutely.
is kind of the core product? And I'm mostly familiar with you all from your research,
Right.
but also know it's it's a listing service for apartments. Helps people find an apartment. But tell us a little bit about apartment list.
Yeah, absolutely. So marketplace business, we're trying to help renters find homes. So if you're a renter, you can go on apartment list and try to find a place to live. If you're a property manager, you can list units to help fill vacancies. And we're really trying to create those matches. And so I think we're not the only player to do this, but I think the difference in the approach of apartment list that really drew me in was, I think, around this understanding that renters really need and want a more guided search, as they've come to expect from many other world-class technology products. Sometimes the sort of silly example I'll give is, thinking about how music consumption has changed over time. I remember when Napster came out, Spencer. You remember Napster? And legality questions aside, it was the first time that a bunch of people said, "Wow, someone put all this stuff online." But it was kind of a blank search bar, and you had to get good at finding
it. Exactly.
Finding
the
what
whole
you
art.
wanted to find. Compare that with what Spotify is now, where you click a button and it understands what you need. It understands if it's Valentine's Day, you either want something lovey-dovey or something angsty. It knows your preferences and that your preferences aren't kind of singular, and can serve up really curated playlists and curated moments for you. I think a lot of real estate technology, despite being a very mature industry, is still in that Napster phase. We put everything online and go to town. And a lot of renters are, as it has probably a lot of listeners were at that time, find that incredibly stressful, and they find that very difficult to navigate. So we're trying to build a product that's much more curated, where we'll ask you more questions up front, and then get to know your preferences, and then categorize. So with the inventory that's out there, here's everything that matches what you're looking for, try to help you get in touch and actually move in. Here are things that here are deals that maybe don't exactly fit your preferences, but if you're willing to commute a little further. So really trying to guide renters through that search, which I find to be, I find it to be a very compelling product vision. It's what I kind of want as someone who has spent many times kind of looking for places to live. But it's also interesting for me as a researcher, because it generates a lot
more data
as a byproduct, because when you come onto apartment list, we ask you about your preferences. And so that means we can then take, as researchers, those preferences and then see how they evolve over time as well, which again, in the pandemic has been especially interesting.
Yeah, that's a great point that I didn't really think about, because if you haven't been on an apartment list yet, like as you described, you first say where you're looking for an apartment, and then you're talking about what points of interest are interesting to you for your commute, and so you're answering all these questions, really kind of qualifying you, and then apartment list will provide essentially a goes through almost like a Tinder or like a matching app in a sense of it's like, maybe yes or no.
Yes.
And so you can all of a sudden kind of put your short list together, because if you look for an apartment in a city before, you've got 100 different options, and how do you narrow down that list? And then it takes all that information and curates you a list. But that's great to understand those preferences. How far are people willing to commute? Who has a pet? Who's signing on their own co-sign? Well, all the different little data points. That's all really interesting and good information.
And it's been funny, as a side note, when I joined, I think a lot of people have referred to it, for better or worse, as sort of a Tinder for places to live.
Yeah.
When I joined, we kind of tried to shy away from that, but
generally
online dating.
When I said that, I was like, "Oh, I hope that's not
mainstream." That it's now not not something that
it's not as risque as it was back a couple years ago.
It's a little funny, but I think it is something that trying to find a place to live traditionally has been one of those painful, searches. So how can you make it fun and make it engaging and give renters the right information? That's what.
And who's your target demo on who's a renter? It's Gen Z and millennials, and then some baby boomers still. But I mean, folks are familiar with that type of process, and it makes sense versus folks that are maybe a little bit older and remember Napster and having to go through and search, and folks remember that.
Yeah,
Wild
maybe I dated myself with the Napster.
No, we were earlier in the day. We were having a conversation about LimeWire. I found a stack of old CDRs that I had burned recently. So no, I'm good old days of Napster.
Exactly.
So not to further try to date you, but I'm just curious. I'm just going back into your background a little bit, because I know the 2008 Great Financial Crisis had a large effect on a lot of people, especially trajectory of careers for millennials. Can delay things. I'm curious. At that point in your life, did the GFC, that housing crisis, did that play in at all to your kind of direction on getting into housing or interest in? And I'm not sure exactly where you were in school at that time. I'm just curious what effect, if any, GFC played in your career.
That's a great question, because I was class of 09. So I was the classic, worst year to graduate for the research shows in terms of financial outcomes. So it definitely played a role, because what that meant was, in my intro to macroeconomics classes as a freshman, we were still talking about the great moderation. This is a term that folks are not
familiar talk about it anymore.
It was essentially, why have the Greenspan years been so steady, and why have we been able to sustain such a mellow economy? And then by the time I was out and working, it was a chaos. So it's a really interesting question that, to be honest, I haven't thought a lot about, but I think what it definitely had a push and a pull for me, in that I think at the time, just economics became such a interesting and relevant topic for mainstream interest, that created that certainly created a pull. And at the time, I think it was also kind of it was a time of booming interest in behavioral economics, which really pulled me in. And I really liked that economics was at this intersection of a lot of things I was interested in. I was a little bit business, a little bit politics, a little bit coding, a little bit math, a little bit of philosophy, a little bit, a little bit of everything, a little bit of psychology, actually a lot of all those things. And I love that it kind of sat at this intersection and took something from all these various things that one could be interested in. And then there was probably also a bit of a push in that maybe if I was, graduating in some wild party time in tech or finance, maybe it would have been harder to go live on a grad stipend for an extended period of time and get a PhD. So there's maybe the opportunity cost of going in and really focusing on research was a little less as well. But I think it did create a moment where there was a lot of interest in how, especially individual markets, will affect the macroeconomy, and how ultimately underneath the headlines and the movements in the stock market, it's driven by human emotions, human behavior, and trying to disentangle that became, a fascination that persists. I think with all of us to this day.
It's why I am not an economist, but I pretend to play one every week on a YouTube show, at least talk about it. But no, it totally makes sense. And it is fascinating because it is the absolute intersection of all of those things, of psychology and business and politics. And I think it's ever more present today than it has been. I mean, you have average conversation on the streets are talking about interest rates in the housing market. And monetary policy, what the Fed's going to do, and so it's definitely it's top of mind. So I want to move just a little bit onto kind of the methodology behind apartment lists. You guys are really transparent on your methodology. A lot of the research groups, they'll have a little paragraph. Some will cite themselves as the source of all information, which I understand proprietary information. But love to give just a little bit of a breakdown on how apartment lists gathers this information, puts it together, makes projections. What's the secret sauce, and what does the laboratory look like?
Absolutely. Yeah, I'm glad you mentioned the transparency, because that was a big kind of a key tenet to our approach going in, was that we really wanted people to understand, especially as a newer research shop, just understand exactly what we're doing. And then, maybe it's the right thing for you to use, maybe it's not the right thing for you to use, but I want you to know exactly what it is. And really, we are using the fact that through operating our platform, we have access to a lot of incredible real-time pricing and availability information for millions of units across the country. And then the question is, how do you aggregate that up into something that represents what's happening in a market or in the nation, with an index or with a data product? And this could be, you could get me on a tangent for an hour, right? That's one of the funny things that it's one of these deceptively simple questions, like what's happening with rents, that you could really design hundreds of different methodologies depending on what precise kind of question.
Yeah, what you're actually talking about and what you're looking for. Yeah,
exactly. And so, are we interested in new leases? Or are we interested in all leases that folks are paying? Are we interested in what houses might hypothetically rent out for if they were all on the rental market? Do we want to control for composition? Do we, all these sort of questions kind of went into, to your point, the laboratory process of saying, okay, what exactly do we want to understand? And I think what we decided is we want to get as close to actual transacted lease prices as we can. And we want to make sure that we construct an index that isn't affected by the composition or the changing composition of the stuff that's on our platform, because our sales team is going on signing on new properties that may be more or less expensive. We've got certain markets have more inventory where we've just been selling in for longer. We don't want kind of the slice of the market that we have. We want have as little of an effect as possible on what we're reporting. And so one common way to solve for this problem is with the kind of a repeat transaction index, which is what we ended up constructing, where we will see a unit, and this is what's great about the granularity of our data. We will see a unit be leased in this month, and we saw that same unit leased last month. And then we can basically say, okay, what's the price difference for that exact unit? There's nothing about
like same store,
same store, and then build that up to city level and national indices. And then so there's still some assumptions going into that's a representative trend. But then what we do to get at the kind of the levels or the rents in the market is then we go back to the latest American Community Survey data, the census data, which we know is wonderful and representative, but the only issue with it is that it's 18 to 30 months out of date. Let's take recent movers in the census and let's see what they were paying for a market or for the nation as a whole, and kind of forecast that to now using the rent index that we've constructed from these same store comparisons and kind of the regression model that we've built up around that to try to get to say, okay, we know what recent movers were paying in the last census. We know that that's a representative number. Let's now forecast that to present day, given how we see prices evolve on our site. And that's essentially how it works, with kind of a lot of nuances baked in there. But it's an interesting kind of design choice for us, because one of the things you'll notice is that one of the very interesting things, and one of the things that we need that made us go towards this methodology, is that there's usually kind of the top research shops tend to have very similar price trends. Levels are very different because the average rent on Apartment List might be very different from the average rent that you might find if you were on Craigslist in that same city or another platform. And it's interesting, the rents in the American Community Survey often are far lower than people expect. So the median rent for recent movers in New York City is less than $2,000. Most people looking and same for LA. And then you have college-educated millennial renters coming on and saying, "Wait, where are these $1,800?
Please show me."
But it shows that the rental market is so much broader than any platform can capture. So we try to use as much external data as we can to sort of get at what that broader picture may may look like.
No, that makes sense. So really using kind of like the census as kind of your baseline kind of consistent metric, and then layering on the higher frequency, more real time informations to kind of get us up to today. That makes sense.
Exactly.
But I'm curious, just because we're talking about methodology in terms of tracking rent, kind of a hot topic this year is so much talk of inflation and CPI is how housing is measured as a part of CPI.
Right.
Housing makes up about like 30 third essentially of CPI, and the big complaint is, or the comment is, the Federal Reserve, which you interned at the Fed in Boston, so great person to ask. I don't know what the work you did there was, but it's so outdated. It's lagging, a good 12 months plus, and they're taking a different measurement of of more effective rent than the market rent and the owner's equivalent rent. I'm curious on your opinion of of how CPI tracks rent and that methodology, and how is that seeping into monetary policy, if at all?
Absolutely. This has been so interesting because, again, someone who is kind of nerded out over how to construct these rent indices.
And this is now a hot topic. They're talking about this on CNBC now, where they never talk about housing.
Absolutely, absolutely. And you can answer two different questions with the rent index, and get wildly different answers, because we have been basically kind of foreshadowing what we'll probably talk about a little later. We've been tracking a quickly cooling market for really the last 8 months, with new lease prices really actually falling in Q4 of 2022 dramatically, and the shelter component of the consumer price index keeps going up, and is a record, not records, but at its highest growth rate in the cycle.
Yeah, it's still growing.
It's incredible. And so there's a so what does this mean? I mean, it means a few things. One, the first thing kind of the first thing to call out is don't go deep in kind of conspiracy Twitter, because it's not a conspiracy. The Fed, the consumer price index is really answering a different question, which is, how is the average rent that all Americans are paying changing over the course of time? And when you think about the price of gas going up, you're not going to feel that until your tank runs out and you go and fill up, and so it may be a week. In the housing market, right, we know that the price of rent goes up. You're actually not going to feel that until you need to renew your lease or you need to move again. And so many Americans, they're not paying these the same sky high market rates that we were tracking at the top, and they're not necessarily getting the steeper discounts because they're not moving every month. So if everyone in America moved a year ago and everyone in America moved this year, then okay, new rent should be kind of equivalent to the average rent. There are other methodological reasons that have to do with the sample for why the CPI actually lags even more, and that's kind of a second component. But the primary, I think, component is that it's really answering a different question. And I think it's not the wrong one, because we're trying to get a sense of how inflation is really hitting Americans' pockets and their wallets, and until they sign a new lease, it's not. So there are good reasons and some methodological unfortunate reasons for why CPI kind of lags new market rents. Or market rents for new leases. Now that's interesting though, because it means that now we have this tugboat out in front in terms of the new leases that are being signed in the market. That's giving us a really good signal of where the bigger, hard to move object of average leases is going to ultimately go. And so there was a moment when the CPI was really, really heating up. We're still at that moment, but we knew that for a third of that index, we were expecting rents to cool down, because we're already seeing the leading indicator cool down. And so there was a concern early on that hey, if the Fed is not looking at this, are they going to overshoot and raise rates too much? The Fed has made it very clear that they are looking at private data sources. Jerome Powell has even presented slides with a bunch of data, including ours, showing that, okay, we get it, we see this. However, we're talking about whether or not there's still kind of pressure that's going to get released into kind of this average rent measure. And so we're confident, right, that rents in the CPI will turn a corner. We're confident that they'll do so soon. We don't know exactly when, but it'll be in the next 3 months. I think.
It should, right?
Dramatic happens, and then the sort of the top line number will really start to cool. But I think at this point, the folks that are watching the Fed closely and are tracking this conversation, they're aware of that. So there's already quite a bit of a discount placed on the CPI shelter component, because I think the economists aren't worried about that component as much as they're worried about some of the other core services components that and just the wage growth
wage price spiral potential is much more of a concern right now. But it's all fascinating because it, just as you mentioned, it's an intersection of politics and psychology. Right. And the Federal Reserve, it's figured out for a long time that their most powerful tool isn't necessarily moving interest rates. It's what they communicate and projecting a certain psychology on the market or changing market psychology. But then also, politics, which it's supposed to be somewhat removed from, but, it's so hard to go out there and say, well, we're going to plateau and keep rates where they are because, well, CPI is up, but we know that rents are going to come down. It's a harder message to communicate where it's, they have to have so many considerations, not just on the monetary policy mandates, but just public perception, which should be not present, but hard to not for it to seep in at some point. While we're talking about the markets, love to just get your kind of overview over the past, since, COVID, since things changed, since like the shoe dropped, what's happened from your mind, from your vantage point, having all these data sources, what's happened the past couple of years? What the heck has been going on? And then where are we? And then what's going to happen?
The series recap, if you missed seasons 1 and 2, here's what you need to know before watching season 3. It has really been a roller coaster in the rental market and the for sale market. And they've roughly tracked, and maybe you're kind of starting to diverge a little bit now, which is interesting. But, you go back to the 2010s were coming off of the great financial crisis, but the 2010s were a pretty stable time, more or less 2 to 3 to 4% rent growth. I think 1 year San Francisco saw 9% rent growth. That was just outrageous and tremendous. The only places that had double-digit rent growth were kind of small towns in North Dakota where they found
oil. Oil boom.
And then all of a sudden, March 2020 hit, and the lockdown era started, and we really dove into the pandemic, and it really created this bifurcation of the types of markets that were heavily affected. So you had the most expensive markets in the country, which were largely coastal job centers. So your San Francisco's, your LA's, Boston's, New York's, they saw dramatic rent declines. So San Francisco lost 25% of its rent from kind of spring to summer 2020. New York, 20%. We saw this massive drop in rents among the most expensive places in the country, where previously folks were paying for location and proximity, and then everything shut down. That entire location proximity premium basically went away, and those rents were in free fall and vacancies were rising. At the same time, that wasn't the whole story, even though that was of great interest to many people. There were also these more affordable and or naturally beautiful but far away Zoom towns that started to boom, right? So some of the Florida markets started to grow. Places like Boise, Spokane, those were kind of the front runners of pandemic rent growth at the end of 2020. Places like Riverside, which was more affordable than LA, but previously hit with kind of a penalty for not being as close to so many jobs. in the LA metro, they started to boom. And then it was interesting because at the end of 2020, we were having this conversation around, will the pendulum swing back? Will we basically go back to huge demand in San Francisco and New York as everything bounces back? Or will these more affordable kind of sister metros next to them, and these Zoom towns and these Sunbelt markets continue to take off? And it turns out both of those ended up being wrong, because what happened in 2021, as probably most of your listeners are well aware, the entire market just boomed. So household growth was off the charts. We gained back the couple million of households we lost in the pandemic, and we added a couple more million across the country. Wages were going up, renter incomes were going up, and basically you saw rents. By the end of 2021, we saw that our national rent index was at 17% year over year.
Yeah, incredible.
And some markets like Tucson, Tampa, Phoenix, they were far outpacing that.
In the past, last decade, there wasn't only a handful of markets that even breached double digits, where then all of a sudden, the average were almost at 20%.
Absolutely. And it was interesting in 2021, our leaders for rent growth were actually Tampa, Florida, and New York City. So Tampa, Florida was going up and started going up more, and New York City had this incredible bounce back.
Comeback,
after and not to mention the actual kind of situation on the ground in New York had the biggest delta.
Well, people are leaving, so people are finally coming back to New York City because there's actually something to do in New York City. Mm-hmm. What I'm curious about is, like the San Francisco has still been lagging behind. Mm-hmm. And then another example, which was a little, I think it's out there on its own, but Minneapolis as well has been incredibly hard hit starting the pandemic. And Minneapolis and San Francisco were just two markets that just have not recovered at all. I think for different reasons. But then New York City has really come back. It's really bounced back. And I think people just now have a second place in Miami and New York City, I think. For a period, it seemed like everyone in New York City had moved to Miami, but apparently people have come back.
Right. Yeah, we have the San Francisco and San Jose metros in our rent data are still the only two large metros that are not back to pre-pandemic rent levels. So rents in San Francisco, rents across the broader Bay Area are actually still lower than they were kind of before the pandemic hit in February, March 2020. And number of reasons for that. For one, they were sky high going into the pandemic. So the benchmark was set at a pretty ambitious place, but it really gets into this really interesting topic of how remote work has really reshaped a lot of the US housing market, and actually continues to do so, even though we're not talking about it quite as much now. And going into the pandemic, the Bay Area was one of the places where there, because of the concentration of the tech sector, it allowed for more of those jobs to stay functioning, right? Which helped kind of what was in retrospect a pretty big tech boom in 2020, 2021, but also kind of untethered all those people from the very expensive markets that they were living in. And so it's been interesting how, and I think tech has also had the slowest return to office, and still there's a bigger question about what really the future of this fully remote versus hybrid versus back to the office.
The conversations. It's been changing, and it's still changing. I think we're still figuring it out, kind of one day at a time.
Absolutely. And I think that's I think what happened was that COVID accelerated a lot of life decisions that were maybe 2, 3, 4, 5 years away for some folks, and created all this new flexibility, which will create new opportunities for the Bay Area, but in the short run really meant that a lot of people did not have to pay, did not have
$4,000, $6,000, $8,000 a month.
Exactly. And so that I think will continue to play out, because it's not like, it's important to remember that remote work is not most of the labor market, and tech is by far not most of the labor, as we're seeing right now, where
I was
the
going to
labor market
say,
is strong and tech employment is
yep.
very weak. But we are, the latest data does say that about a third of employed days are worked from home right now, and these sort of remote friendly job untethered renters are really representing a disproportionate share of the high income rental market. And so folks that are managing properties and communities that are really geared towards six-figure earning, college educated Gen Z millennial renters, of which that's been a growing segment long before the pandemic. The remote work question is very consequential to understanding how the heat will get spread out throughout the U.S. rental market as a whole. And they're more mobile, right? Because once you're untethered from your place of employment, we've actually found in recent surveys that hybrid workers, folks that are in hybrid work environments, they say for 2023, they're more than 50% more likely to be considering a move than those that are working on site. And so it's still kind of this background factor that's really going to be important for how the distribution of action in the rental market plays out.
Yeah, no, I saw that on the recent migration report that you all put out here just back a couple weeks ago, back in February. That I was surprised by that statistic that so many people who had moved recently to a new market were considering moving to another market. I guess try it, keep moving. You're not tethered. Your job you can take with you. So I guess try something else out. Right.
And one of the most interesting things that I've gotten from really studying our kind of metro to metro flow data, because we'll see, it's not, we don't really have migration, right? But what we do get is kind of this leading indicator of who's searching where and at what rates, is just the degree to which some markets operate much more as revolving doors than others. Some have this kind of absorbing state. Like Phoenix tends to be this way. A lot of people are looking to move into Phoenix. When you see people with Phoenix IP addresses, they tend to still be looking in Phoenix. The tech heavy markets, the Austins, and not just the big ones, but the Austins, the Charlottes, the San Jose's, they really have a lot of people in them that are looking to leave, and a lot of people not in them that are looking to come. And they have really different dynamics from at the other end of the spectrum. The Midwestern markets are much more stable. They have much more kind of action internally, and that creates some more stability as we're seeing now for them as well.
And now, so you're in the Bay Area. I'm just curious, boots on the ground, what are you seeing? Are things kind of coming back to life? Are people going back to work in the Bay Area, San Francisco, and around where you are?
People are return to office has been generally slow, I think, but certainly the Bay Area feels like it's coming back to life. So it's not, they're related, but they're not really one and the same. I think the big companies have had a hard time getting folks back at their desks.
But it's a place that people still want to be. The hardest part is just it was too expensive in the past.
Right. And I think that the Bay Area is a constant place of reinvention. For better or worse. It's changing, if anything, more quickly than most people are often comfortable with. And so it'll go through a new phase, but I think the transition dynamics are pretty can be challenging. And so there's certainly the conversation is there's a lot of life kind of back in San Francisco and Oakland and the Bay generally. There's housing is still expensive, but you talk to most folks who are working at Google or Meta, they're still not 5 days a week. That's for sure. So the sort of the Silicon Valley campus culture seems to be over. But the vibrancy is still there, and it'll morph into something quite different.
But that's good. Yeah, no, I wouldn't count when people talk talking New York City now, the whole idea like, well, is New York City dead? It's like, well, no, I wouldn't count New York City or San
Right.
Francisco,
Right.
Bay Area. I wouldn't count those metros out just yet, because just as you said, they've all gone through
Right.
periods of transformation in the
Mhm.
past, and this is
Mhm.
not unlike what they've
Right.
gone through in the past.
Right. With that said,
Yeah,
I
yeah,
think the cultural importance, we haven't quite seen the full cultural implications of the tremendous growth of the Sun Belt and the Mountain West. I
it's
think a
true.
lot uh, a lot of media is still coming from uh, California, New York,
Yeah,
Chicago. A lot of they're still kind of considered the bigger market. I think a lot of people that are not in these markets, like Phoenix, Vegas, Denver, Tampa, kind of underestimate the type of growth that they've really the transformation they've seen since
yeah.
the financial crisis. So
I
there's something
mean,
to be said about the distribution of economic and cultural relevance in the U.S. too, with just the dramatic differences in who's been letting their towns and cities grow and who's been kind of actively constraining that growth or
yeah.
resisting some of that broader change.
Yeah. No, I mean, when I think about like a market like Miami that has been
Mhm.
the beneficiary of so much of
Mhm.
this migration, again, especially from the East Coast,
Mhm.
and then combined with just the demographic moves and of aging population and people just wanting to move down to Florida.
Mhm.
But then, financial centers are moving
Right.
down there. Financial institutions are some opening satellite offices, some moving their corporate offices down to
Right.
Southern Florida or Florida, and that changes. It changes a lot of things about those markets, and it not just Miami. It's a lot of those Sunbelt
Yeah.
metros that have seen a lot of change over the last several years, and it's not a trend that's going away anytime soon.
Mhm.
Why we're talking about the Sun Belt, and then I want to talk more about the apartment list national rent report, because there's a couple projections that I had some questions about and was curious. Um, but for the Sun Belt, there's a lot of talk of a lot of oversupply in a handful of markets. Especially like a market like Huntsville, Alabama, or like a Phoenix or an Austin, markets that have had incredible amount of growth over the last
Mhm.
um, decade and are going to continue to see great growth.
Mhm.
Um, any insight? And I know that on the supply side isn't an area that Apartment List really digs into as much as rent growth.
Mhm.
But curious if you had any opinion or take on pressures from the supply side over the next couple of years in the Sun Belt or elsewhere.
Absolutely. Well, I think that's going to be the big story in the rental market this year is really, the supply that we've been waiting for for some
Yeah,
time now. And it's been, and it's not just with, big multifamily developers. It's ask anyone who bought an unfinished townhome and they got it delivered 6 months
oh
later
yeah,
than they thought, or if,
oh
or
yeah,
maybe they're still waiting for,
yeah. Try
that.
ordering a couch. I mean, yeah, everything. Yeah,
Absolutely. And so, we're at a point where, and this is where I actually think the rental market story is starting to diverge from the for sale story, because the for sale market, we're still tracking very little inventory, very little movement, a kind of a market that hasn't thawed.
yeah,
Um, in the rental market is expecting, it basically has almost 1 million apartments under construction that's going to be kind of showered across the country in the next 18 to 24 months. A lot of that coming online this next year. Now, a lot of that will be at the higher end, as most kind of newer construction tends to target higher income renters, but that's going to have a big effect on rent prices and essentially cap the amount of rent growth I think we're going to be able to see, even with potentially a robust recovery in demand. And so
yeah,
um, renters are going to have a lot more options, especially kind of higher income renters are going to have a lot of options and probably a lot of rent specials thrown at them to try
yeah,
to. We're going to see properties competing for renters far more than we have in these last few years, and I think renters are really going to be in a lot of segments, at least, back in the driver's seat and kind of have some optionality. Now, you always have to kind of caveat that a little bit, because there's a broader structural kind of undersupply and underdevelopment in the U.S. as a
Yeah,
whole. And so,
exactly. On the other side, we've had a housing crisis. We need to build, a couple more million units.
exactly. And so
But
it sort of depends on, it's sort of like the difference between asking, what effect should we see from global warming and how much is it going to snow tomorrow? It's like you're
exactly.
looking at it on different, on a kind of different time scales. And so affordable, kind of lowercase a affordable housing and capital A affordable housing will still be very hard to come by. I think, we would have to see a lot of really quick filtering of these rent effects to see a lot of ease for lower income renters. So you kind of have to give that caveat, because there are broader structural issues that, we are not, it's sort of like, I guess, again, with the weather example, like California has been going through an epic drought and just got a ton of rain. Well, does that mean we're not in a drought anymore? No, it's better, and it's flooding.
We're building a lot of very specific product in a lot of concentrated areas. And like you said, it's all the higher end product in a lot of downtown CBDs. And because a lot of that demand was kind of forecasted from, 36 plus months ago, where there was so much demand in the CBDs. So it's a lot of supplies coming online, but it's not necessarily evenly distributed.
That's right.
Where and it's not necessarily the price points where a lot of the demand currently is.
Yeah, and it will ease up the whole market, because that means that that higher income two Gen Z lawyers will get that new build instead of taking up the single family home. So that will all continue to happen. But basically, it will look very different from these past few years, where we continue to see inventory and the rental market rebounding. And we're actually, in our vacancy index, we're tracking that we're going to be basically back to our pre-pandemic average vacancy level in the next 1 to 2 months.
We're back up we're projecting, we're right now we're at 6.4%, according to the latest apartment list report. I'm up from, 4.1%, kind of bottoming out back in, late summer of 21.
Late summer of 21, where all that new demand just gobbled up all the available inventory, and everything got sort of stuck. And now we're coming back to a point where there are options, which is a stark contrast to the conversation that they're having over in the for sale market, where there's very little inventory, very few active listings, concerned about homeowners not selling, concerned about first-time buyers being priced out with relatively high mortgage rates. And so that's going to be a big story. And I think it's going to, I don't expect any sort of crash. I don't expect we'll end the year with rents having fallen throughout 2023, but it will put a cap on the type of rent growth we can expect. Certainly nothing like the boom times of 2021.
I think that's for certain. So, okay. So Igor, I have two quick questions. One, one, I want to ask, because you mentioned a couple times of that divergence between the rental space and the for sale space. I heard you mention that kind of twice. And the reason why I'm interested is one thing that I forget who I heard this from. It might've been from, I think it was from John Chang from Marks and Millichap back in 2020. I was surprised that the rental market was doing so well when the for sale market was also doing so well. I assumed that some of that demand would shift, and I kind of heard the saying that a strong housing market is typically a strong housing market for both for sale and for rent. It's not typical that you see everyone's buying but not renting, or vice versa. Are you seeing a little bit of divergence there? Is that even true, that what's good for housing is good for housing?
I think that's true. I think that there's sort of the not to get too econ-y, but there's sort of the all else equal analysis. In the all else equal analysis, the rental market and the for sale market compete, and especially the for sale market is an important pressure release valve for the rental market, because as renters get older, they get kind of further on in their earnings cycle, their families grow, they kind of leave the rental market and free up that space for new renters. And certainly we've seen that with the challenge of first-time homebuyers, especially in the pandemic housing market, that has created a lot of pressure, and a lot of I think that pressure has gone towards more build for rent
Yeah.
development to satisfy that demand, more single family rentals, and more price pressure on the rental market, all else equal, right? That doesn't mean necessarily that these two won't move in parallel, just the same way that I would, guess that, same way that gas stations compete. and,
Yeah.
and,
Yeah.
and but when the price of oil goes up, all the price of
It hurts everybody. Yeah. No.
it's gonna drive prices across the board. So there's sort of the broader question is just, it doesn't necessarily mean that when something good happens in the for sale market, it's gonna hurt the rental market in totality, but that effect is still there. It's just not the primary driver, because I think the primary driver is housing demand, household formation, confidence in the economy, and all these other kind of aspects that are going to just move the whole thing up and down by relative scale.
That makes a lot of sense. And just on household demand, household formation, so like we talked about record household formation in 2021. The last quarter, so really 8 months, we've seen some of the lowest household formation that we've seen in a decade or more. The question has been, is that creating some pent up demand that's going to be released sometime this year, or are people just so uncertain about the economy, not wanting to make decisions, and it's a little bit longer standing trend we need to watch out for?
Yeah, I think it really depends on how the economy goes.
Yeah, that's a trick. That was a trick question.
Yeah, it's maybe the least interesting answer. But if things go okay, right, then we will see young adults starting their own, forming households again. And I think there's probably a bit of pent up demand, but also I think some of the 2021 boom moved forward some of what might have otherwise happened in 2022. And so there's some positive signs, like immigration is bouncing back. That's good for household formation, certainly, because it really had fallen off a cliff in the pandemic. But we're still seeing a lot of whether or not it's from 2022, there's a lot of latent demand out there with just the number of young people that are living at home now. Generally, I think a lot of I think people underestimate how important of a factor that decision is for the reality of being kind of a young adult right now. Is a lot of that margin of do I get my own place, maybe with roommates, or do I live at home with my family, or some combination where my family lives with roommates, right? All these situations are quite common. And so if folks are really feeling confident, there's a lot of potential demand out there for household growth. But whether or not we'll see it really just depends on how this economy goes, and how this economy feels really depends on where you are right now.
True, very true. Yeah,
the tech sector feels kind of like beat up right now. Other industries are really bouncing back, or just soaring quite well. And it kind of depends on who you are and where you are. There's really not a single economic narrative in 2020.
No, it really, depending on the day, literally, or which part of the day, you can really feel like we're in a different economy. I mean, one day it seems like things are going so well, and just a little bit too well and too hot, and we've got this soft landing that we're it's gonna be all great. But then all of a sudden, the flip side, and of course, good news is bad news. You can paint any picture. Choose your own adventure right now. So it's pretty fascinating. So one question on the apartment list, National Rent Report. It usually there's a divergence between a lot of the different research groups out there. But one consistent data forecast that we've seen in a lot of the national rent projections is we're back to 3% rent growth. And so is that where, are we just back at 3% because there's so many unknowns that we have to kind of discount some of the data and say it's probably going to be 3 because that's just kind of the average and we're getting back to normal? or is just that's where the data is pointing us to? I'm just curious, because I know that there's a lot that goes into that, but it's a lot of consistency across different groups of going to be an average year of 3% rent growth.
Yeah, and funny enough, now we just released our new report, and we're currently at 3% year over year. Exactly.
I saw that right on the dot.
3.0, right on the dot. And so, I think that there's, we've gone through such whiplash in the market right now that it's very natural for the industry to generally be benchmarked against what was the stable process of growth that led into the pandemic. And that was 3%. So I don't know if there may be a little bit of, back to the behavioral economics, there might be some anchoring happening across the industry where there's a sense that, well, if things kind of feel a little more normal, what's normal? Okay, well, 3% was what we were more or less seeing. But and there are reasons for kind of why that was roughly the growth rate that was sustained. But I think it's we don't actually produce kind of a quantitative forecast, but of course, if you ask us what's going to happen, we'll
which is what everyone wants to know. What's going
to? But I think that what I don't think that folks are expecting this to be a year of extremes. Is basically the sort of the categorization, just because we've gone through, even last year, the first half was hot, the second half was ice cold, and so. There are reasons to expect now, with demand being the real X factor, that there will be some bounce back, but that bounce back in demand is going to be moderated by all this new supply coming online. And so we shouldn't expect or plan around a crash or a boom. Even though it won't feel maybe like a return of normalcy, I think there are forces that will keep the market from going too soft or too hot. And maybe if when folks are asked to put a quantitative number on that sentiment, that's 3%.
Yeah. No, well, it makes sense to me. I mean, because this does feel, as volatile as things still are, a year of could be more normalization. We're kind of just getting back to not necessarily where we were, but just some degree of normal. Again, not maybe normal 2019 normal. I don't know if it's 2003 or 1996 or when, but it's definitely everyone understood that 2021 was not normal. That type of growth was unsustainable. As you said, we had, we almost had basically 3 years to 5 years of growth compressed into a single year. And it really was like an era of time compression in a sense. Now we're kind of expanding back, decompressing from that, maybe reverting to the mean, but it's fascinating times as an economist. I can only imagine being on the, not necessarily sidelines, but just someone who just is getting interested and fascinated by it. It's been great to watch. And again, following what you guys are doing in Apartment List has been absolutely awesome and fascinating. But before we go, we talked about on the migration report that you guys put out, one of the interesting takeaways of, 40% of those who are searching for new apartments were looking for a new metro, 27% were searching for apartments in just new states. Any other kind of big highlights or kind of takeaways from that report on where people are going and why? Or
I think a couple of things. One thing that we've found throughout the course of this changing market is that the channels that migration is happening along have been fairly consistent. It's a matter of kind of scaling up or scaling down, but still folks from LA are moving largely to Riverside Metro or Phoenix. Folks that are moving to Boise are coming from Seattle or Salt Lake City. The channels don't change too much, but the degrees change quite a bit. But one of the things that we dove into in this most recent report was just the differences between those folks that are searching across metros versus staying local. We find that those that are moving across metros are coming in with much bigger budgets. And so they're really, maybe reflecting some of this new opportunity for the kind of the newly hybrid, newly untethered workers. But I know if you go to most places in the West, they'll argue about how Californians are are moving in and driving up rents. And if you
Oh
go
yeah.
to most places in the East, they'll argue about, New Yorkers moving in and driving up rents. And we do see, right, that if you look at Florida, inbound renters from California are coming in with 30% higher budgets. Those from New York are coming in with 25% higher budgets. And that's just true across the board, that these more mobile renters are the ones that are going to drive kind of the most heat in the market. And I think that circles back to why the unresolved remote work question is such an important one for the rental market, because that's the demographic that's driving some of that action across markets.
Yeah, and they are much more mobile than all of the new supply that's being delivered in those markets. It's not moving anywhere. So
That's right.
those developers are hoping that they are the recipient of that migration, and they actually stick around for more than a year or two.
Exactly.
Well, Igor, I know we've gone over time. This has been an awesome conversation. What's a good way for folks to get in touch with you if you want people to reach out to you? What's a good way to get in touch with you or Apartment List?
Very easy is research@apartmentlist.com. That goes to the whole team, and we always love chatting data with folks. And then apartmentlist.com/research is where you can find kind of all of the data assets, the reports, the research that we try to get it all out there on the blog. So would love for folks to engage and reach out as they have questions or comments.
Absolutely. And again, anybody who's a regular, semi-regular watcher, listener of the Gray Report, you're familiar with Apartment List because we feature it all the time. But I highly recommend, if you're interested in housing studies, housing market research, check out apartmentlist.com. Just the research tab is not only they have a lot of just really good articles and blog posts, they've got a lot of great tools. They do a lot of great data visualizations. Again, if you're watching any of our episodes, we feature them pretty frequently. So definitely check it out. Igor, really appreciate your time. Appreciate all you all do at Apartment List, and we're gonna have to have you back on if you'll come back on at some point. Give us an update.
Great. Yeah, thank you so much for having me on. This was fun.
Awesome. All right, have a good one. Take it easy. Thanks, Igor.